Hello and welcome to today's financial podcast. I am your host, Alex.
Everyone, I am Bailey. So, what are we talking about today?
Today, we're discussing a very interesting topic, the Pennsylvania Plan. This plan has been causing quite a stir in the financial world recently, with Deutsche Bank just releasing a report on it.
The Pennsylvania Plan sounds mysterious. How did it get this name?
It's quite interesting. Actually, the plan is called the Pennsylvania Plan because the US Treasury Department is located on Pennsylvania Avenue, so they named it after that street. Unlike the previous Mar-a-Lago agreement, this plan seems much more viable.
So, what problem is it trying to solve?
It's mainly addressing America's dual dilemma, fiscal deficit and trade deficit. The US isn't just facing debt problems, but also trade deficits. This has made America highly dependent on foreign capital. And once foreign investors stop buying US bonds, America becomes very passive.
Right. I remember there was a sudden stop in foreign capital inflows recently, which directly caused US bond yields to spike.
Exactly. So the core idea of this plan is to redistribute US Treasury ownership from foreign investors to domestic investors through Treasury Department coordination.
Sounds like a closing the door and beating the dog strategy. How exactly would it work?
The key is stablecoins. They plan to have US domestic private sectors like Apple and Google, these cash-rich companies, purchase US bonds, then use these bonds as collateral to issue stablecoins.
What are the benefits of doing this?
The benefits are numerous. First, even if foreign investors want to sell US bonds, it won't affect America because the bonds are all held by US companies. Second, stablecoins can replace dollars for overseas expansion, but the bonds stay domestic, so it doesn't increase foreign debt.
This is indeed clever, but Wangre, here is the market demand for stablecoins.
This is even more interesting. Stable coins theoretically operate outside traditional financial regulation, so they can reach places that are sanctioned and where dollars can't go, like Russia and Iran. This way, America can continue trading with these regions without publicly lifting sanctions.
There are other use cases?
Absolutely, many developing countries have unstable currencies, like Argentina, and they need quasi-dollar currencies. Stable coins can serve this purpose also. Stable coins are easy to transfer across borders and difficult to tax and regulate, making them attractive for capital transfers.
It sounds like this plan kills multiple birds with one stone.
Indeed, through this plan, America can solve its debt problem, allow dollar depreciation to boost exports, and maintain global pan-dollarization through stablecoins. It's a very sophisticated design.
What countermeasures do other countries have?
Europe is pushing digital euros. China is pushing digital yuan. There are also opinions about returning to the gold standard using gold-backed stablecoins to compete, but these are all still in exploratory stages.
It seems this financial game is just beginning.
Yes, regardless, we must acknowledge that this Pennsylvania plan is far more sophisticated than the previous Mar-a-Lago agreement. It's not only theoretically feasible, but also highly operational.
All right, that's all for today's show. Thanks for listening, and we'll see you next time.
See you next time.